What I'm about to say is uncomfortable if you're thinking about buying a home. It might completely change how you see this market.
March. Most people see a page on a calendar, a 3-week frenzy, a bracket. But we know the action, to move along steadily, to refuse to break stride when the pressure rises.
Every year, over 70 million Americans fill out a March Madness bracket, believing they can predict the outcome. The odds of the perfect bracket are 1 in 9.2 quintillion.
His hands in the paint, floater, short, got it back, ties it with 3. Gonzaga has time to do something. Suggs for the win. Oh, yes! Unbelievable! Unbelievable! The perfect season!
Translation: the perfect bracket doesn't exist. But in housing, millions of buyers are still trying to build the perfect bracket. Perfect rates, perfect prices, perfect timing, perfect market conditions. And while they wait, the scoreboard just keeps moving.
People talk about a fog of war, but there's a fog of panic too. And during that panic, you're getting inaccurate information, you're hearing rumors. If you wait till you know everything, it's too late.
That's right, and home prices in the United States have increased roughly 85% of all years since 1990. Mortgage rates have averaged about 7.7% since the 1970s. And over the past decade, the average homeowner gained roughly $225,000 in equity. This is according to CoreLogic. So the uncomfortable question becomes this.
I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market's going to do.
Are buyers actually protecting themselves by waiting, or are they quietly eliminating themselves from opportunity? Because markets don't pause for hesitation, they advance.
When he walked into the meeting, and he looked us right in the eye, he said, "Gentlemen, we're going to relentlessly chase perfection, knowing full well we won't catch it because nothing is perfect."
Vince Lombardi once said, "Perfection is not attainable, but if we chase perfection, we can catch excellence along the way." The problem is most buyers aren't chasing excellence. They're chasing certainty. And certainty doesn't exist in March Madness. It doesn't exist in investing, and it doesn't exist in housing.
To me, the mentality is a really simple one in the sense that the confidence comes from preparation.
Another way to look at this is luck isn't random. Luck is when preparation meets opportunity. So when opportunity shows up in a volatile market, but you're still waiting for clarity, did you miss your moment? Or did you never even step on the court?
That's right, because in today's market, mortgage rates can move 0.75% in a single week. Energy prices, they can reshape inflation expectations overnight. And buyer competition, it can return the moment rates dip, which means trying to perfectly time the housing market might be the fastest way to eliminate yourself from it.
So here's the defining question for this episode. If perfection is statistically impossible, why are so many buyers acting like they can actually predict the perfect tournament bracket?
You tripping.
He said, first play of the game, I know what they're going to run, and he knew Powell's going to be the last screen. And he said, I'm running through that motherfucker.
I swear, the first play of the game. We was like,
every March, about 70 million Americans fill out a March Madness bracket. That's basically 1 in 5 adults saying, yeah, I can predict how this whole thing's going to play out. And every year, most of them are wrong. The statistical odds of filling out a perfect bracket are 1 in 9.2 quintillion. That's not a tough bet. That's an impossible bet. But here's what really matters for what we do. Home buyers, they build mental brackets too. They just don't call them brackets. They call them timing strategies. They're trying to predict where rates will go, where prices will go, what the Fed will do, when inventory will improve. And just like in March Madness, they believe if they think hard enough, they can outsmart probability.
That's right, and the scoreboard in housing is way less forgiving. The U.S. homeownership rate today is roughly 65 to 66%, which means about 1/3 of Americans never actually close on a home. About 6 million people attempt to buy homes each year, but only about 4 to 4.2 million actually close. So roughly 30% of buyers who try, they get eliminated. That's your first round upset.
Right now, there are roughly 1.1 million homes for sale nationwide. A balanced market would be closer to 2.3 to 2.5 million. Freddie Mac estimates we're underbuilt by 3.8 million homes. So buyers aren't just competing, they're competing in a bracket where half the teams don't even exist. And here's something people don't talk about enough. This whole bracket mentality isn't just fun and games. It's actually behavioral finance. There's a concept called overconfidence bias. It's when people believe they can predict the outcomes that are statistically unpredictable. Studies show nearly 90% of individuals believe they are above average decision makers. But in markets, confidence doesn't change math. Probability still wins. And housing is one of the biggest probability games most people will ever play.
Yeah, and the data backs that up in a really uncomfortable way. According to the National Association of Realtors, about 70% of first-time buyers say they tried to time the market before actually purchasing in the market. But when you track long-term outcomes, buyers who delay purchases just by 24 months often face home prices that are 8 to 12% higher depending on the cycle. So what feels like a cautious decision could actually become a compounding cost factor. That's not theory, that's historical trends.
And let's connect that to inventory cycles, because this is where the bracket even gets harder. Back in the early 2000s, the U.S. had roughly 2 to 2.5 million homes available at any given time. Today, we're operating closer to half that level, which means buyers aren't just competing against each other, they're competing inside a structurally tighter tournament. Fewer listings, more pent-up demand, a generation of homeowners locked into sub 4% mortgages. That supply constraint changes the entire probability model.
Yeah, and when we look at elimination rates for first-time homebuyers, this becomes even more real because roughly 1 out of every 3 first-time buyers who start the process, they don't complete it within 12 months. Not always because of credit or not because of income, but oftentimes because of hesitation, because they're waiting for rates to drop, prices to soften, or markets to feel safer. And while you're waiting, someone else advances in the bracket.
Hey, long-term home prices appreciation have averaged about 4.8% annually. Rent inflation averages about 3.5 to 4%. So waiting 2 years can mean higher home prices, higher rent costs, same uncertainty on rates. That's like waiting for the perfect shot while the bracket just keeps moving. Mortgage rates averaging about 7.7% historically, and today's mid 6% range is actually below those long-term norms. But buyers anchor to 2021, that psychological anchor busts more housing brackets than affordability itself.
So the uncomfortable reality is this. Housing success has less to do with predicting the future and more to do with surviving long enough to let probability work in your favor. Just like March Madness, the teams that win it all aren't the ones who avoid every mistake. They're the ones who stay in a tournament long enough to let momentum build. And in housing momentum, it's equity. So the real madness isn't buying at the wrong time, which people think. The real madness is believing perfect timing actually exists.
All right, mortgage rates moved roughly 0.6 to 0.75% higher in just a few weeks. What does that mean? On a $500,000 loan, that's about $250 more per month. The Mortgage Bankers Association data shows every 0.5% rate increase cuts purchase applications by about 8 to 12%. So volatility creates hesitation.
That's right. And when we look at the 10-year Treasury, it rose roughly 40 to 50 basis points. Mortgage rates historically run about 1.7 to 2% above the 10-year yield. Oil, it's above $90 per barrel, and it raises inflation expectations, which pushes rates higher. Macro chaos reshuffles the housing bracket. Now let's break down the chain reaction here in plain English. When energy prices spike, it raises inflation expectations across the economy. Inflation expectations move bond yields higher, especially the 10-year Treasury. Now, mortgage rates are priced off that bond market. So when oil prices move fast, mortgage pricing doesn't wait for clarity, it reprices immediately. Historically, every sustained energy shock cycle has led to higher borrowing costs across housing. We saw this in the late 1970s, we saw it during parts of the early 2000s, and we saw a modern version of it again recently in 2022. This isn't a new playbook, it's a repeating one.
And that's why volatility matters more than direction sometimes. Buyers just don't react to the higher rates, they react to uncertainty. The Mortgage Bankers Association data shows purchase applications swing about 15 to 20% during high volatility rate cycles. Not because affordability suddenly collapsed, but because psychological confidence did. That hesitation becomes its own economic force. It slows transaction, it reduces listings, and it delays decision making, which ironically can tighten markets even further.
Yeah, so Manley, let's put this math behind payment shock, because this is where most buyers emotionally disconnect. Let's say on a $500,000 loan, a move from 6.25 we saw all the way to 7%, that changes principal and interest by roughly $250 to $300 per month. That's about $3,000 to $3,600 per year. Now let's compare that to long-term price appreciation trends. At just 4% annual appreciation, that same home could gain about $20,000 in value within 1 year. So buyers fixated on monthly volatility while equity growth compounds quietly in the background. That mismatch in perception is where bracket decisions get completely busted.
The historical comparison makes this even clearer. During the 2008 housing crisis, mortgage rates fell significantly, but transaction volume also collapsed. In 2022, rates rose faster than almost any point since the 1980s. Yet home prices still showed resilience due to the structural supply shortages. Different environments, same lesson. Markets don't move in straight lines, but long-term participation has historically outperformed short-term timing.
Yeah, so let's frame this up. So when buyers say, I'll wait until things calm down, they're often unknowingly waiting for the very moment competition comes running back in. Because lower rates just don't improve affordability, they increase the demand, which reshuffles the bracket all over again.
So if segment 1 was understanding the bracket, and segment 2 was watching the chaos, segment 3 is about winning the tournament. Because here's the truth most buyers don't hear. Successful homeownership isn't about perfect timing. It's about positioning strategy. And historically, the buyers who win are the ones who focus on the controllables. Not headlines, not predictions, not macro noise. They focus on their own numbers.
That's right, because when you look at long-term outcomes, time in the market has consistently beating timing the market. In fact, since 1990, the median U.S. home price has increased roughly 290%. And at the same time, the average homeowner who held property for at least 7 years, they experienced significantly lower probability of loss, according to the Federal Housing Finance Agency data. So ownership, it behaves less like a single game and more like a full career season. Short-term volatility matters less than long-term participation.
And this is where strategy replaces emotion. For example, refinancing probability is one of the biggest misunderstood factors. Historically, about 60% of mortgage borrowers refinance at least once within the first 10 years, meaning the rate you start with is often not the rate you finish with. But buyers treat their initial rate like it's permanent. That mindset alone eliminates more buyers than affordability itself.
Yeah, and let's look at the equity growth, because this is where home ownership becomes transformational. Over the past decade, the average homeowner, like we saw, $225,000 in equity, that's a big number according to CoreLogic. Now, even in moderate appreciation cycles, principal paydown plus appreciation, that can build $40,000 to $60,000 in wealth within a 5-year span. That's the compounding effect renters, they're never going to capture. So the real championship move is entering the game early enough to let time run the scoreboard.
Let me put a real-world example to this. We worked with a buyer last year who almost walked away from a purchase because rates had just crossed back above 6.5%. They were convinced they should wait, but inventory in their price range was already extremely tight, so they decided to move forward anyway. Within 12 months, that same neighborhood saw prices rise about 5%. So, On their purchase price, that translated to nearly $30,000 in increased value. Meanwhile, their payment difference versus waiting would have been about $180 per month. The math felt scary at the moment, but it actually becomes a long-term advantage. That's what participation looks like in real life.
Yeah, well said, Manley. And that example, it ties directly into the refinance behavior. Historically, about 60% of mortgage borrowers, they refinance within the first 10 years, which means the rate environment of which you buy is rarely the rate environment you live with long term. So buyers who wait for perfect rates are often solving for a short-term variable and what fundamentally is a long-term decision. That mismatch in time horizon is where many housing strategies completely break down.
Another strategic factor is competition timing. Redfin data shows buyers' demand tends to surge whenever mortgage rates drop even 0.5%. So waiting for lower rates often means entering a more competitive environment, which reduces negotiating power. It also reduces concessions and increases bidding pressure. In March Madness terms, that's like waiting for the Final Four to start playing your first game.
Yeah, and the psychological side of home ownership isn't really talked of enough either. I mean, survey data consistently shows homeowners, they report higher levels of financial confidence and long-term planning stability compared to renters. Not because ownership eliminates risk, but because it creates structure. A fixed payment, a predictable asset, a compounding wealth mechanism.
Yeah, and that structure changes behavior. People plan differently, they think longer term, they make decisions with more stability because they have financial foundation under them.
Yeah, exactly. An affordability strategy isn't just about price, it's about structure. Buyers today can use tools like temporary rate buydowns, which is my personal favorite, adjustable rate mortgages, seller concessions, and refinance planning. Historically, about 35% of first-time buyers, they use some form of structured financing strategy. It's not just standard fixed rate loans anymore. You've got to be creative.
Which means the buyer who succeeded today aren't just hoping the market works out. They're building a plan to make it work.
So championship buyers, they're not just guessing, they're engineering their path into home ownership.
So when we step back from the madness, the pattern becomes clear. Volatility doesn't eliminate opportunity. It rewards preparation. The buyers who win this tournament aren't the ones who waited for calm. They're the ones who understood the rules of the game and they played anyway. Because in housing, the championship isn't buying at a perfect moment. It's building financial momentum over time.
Yeah, so if markets are always going to feel uncertain, which they will, the real question isn't whether volatility exists, it's whether you understand how to navigate it. Because strategy without awareness, that's just theory.
Exactly. And right now, the market has its own scoreboard. So let's stop talking philosophy for a minute and look at what's actually driving mortgage pricing today. All right, folks, let's take a look at the Mortgage 101 Market Dashboard, where we break down the 4 key indicators that are driving mortgage pricing right now. Starting with the 30-year fixed mortgage rate, which, depending on the swings of the day that we've seen in the last couple of days, is currently operating around the mid 6% range. That's higher than where buyers got comfortable last year, but still below the long-term historical averages.
Yeah, and the reason rates are holding here comes down to the bond market. The 10-year Treasury yield, which mortgage rates historically tracked, is now sitting around 4.3 to 4.35%. That move higher reflects ongoing inflation concerns and continued macro uncertainty.
Now let's talk about the actual engine behind mortgage pricing, the mortgage-backed securities market. Right now, the UMBS 5 coupon is trading in the high 98 range, which indicates continued pressure on mortgage pricing as investors demand higher yield for risk. When MBS prices fall, mortgage rates rise. That's the transmission mechanism buyers need to understand.
Yeah, and on top of that, Manley, we're still seeing mortgage spreads near 2%, which remains elevated compared to historical norms. That wider spread means mortgage rates can stay higher even if Treasury yields stabilize. So buyers watching only headlines about bonds, they aren't seeing the full pricing picture.
Now zooming out, the dashboard really shows us the market that's still reacting to inflation expectations and global economic risk. Energy volatility, Fed uncertainty, and investor positioning are all feeding into this rate movement right now.
Yeah, and until we see a clear disinflation trends or the 10-year treasury move back towards the 3% range, mortgage rates, they're going to continue to move in bursts rather than smooth trends lower.
So the takeaway from all this dashboard isn't fear, it's awareness. Because this isn't a prediction tool, it's a real-time snapshot of the conditions buyers are navigating today. All right, folks, now it's time for our ever-popular Buzzword breakdown segment with our always popular producer, Ryan. Ryan, take your shot. The court is yours.
Appreciate that, Manly. All right, gentlemen, March Madness edition. Same rules as always. 5 mortgage terms, quick answers, no overthinking. Let's see who advances. First up, we have rate volatility. Manly?
Rate volatility is like when you get upset about the rates and start throwing chairs around the court, yelling at your players? Or does that mean mortgage rates are moving quickly over a short period of time? And it's not whether rates are high or low, it's about how unpredictable they are. And that volatility, it creates hesitation, and people struggle to make decisions when those conditions feel unstable.
All right, buzzword number 2 is mortgage spread. Anthony, tell us about it.
Yeah, mortgage spread, that's a good one. That's the difference between the mortgage rate and the 10-year treasury yield. A lot of people think the 10-year treasury, hey, if it's sitting at 4, why is my rate not at 4? Normally, there's around a 1.7 to 2% recently wider adder due to the market uncertainty, which keeps mortgage rates elevated even when bond markets improve.
All right, buzzword number 3 today is inventory shortage. Manly?
Inventory shortage means fewer homes for sale than buyers who want to purchase. The U.S. is still underbuilt by 3 to 4 million homes. That structural shortage is the major reason prices remain resilient.
All right, buzzword 4 is buy down. Anthony?
Yeah, so a buy down is when a borrower or a seller can pay upfront to reduce the mortgage rate. So it can be a temporary or a permanent buy down. And the key here is the affordability tool in the higher rate environments. We want to make sure it's a break even. That's why these short-term buy downs make sense. So rather than having like a 5 or 6 year break even, meaning how much am I saving versus how much it's costing me, you can do a temporary buy down and accelerate that savings.
All right, final term for today, Manly. Tell us about time in the market versus timing the market.
Timing the market means trying to predict the perfect moment. Time in the market means participating long enough to benefit from the appreciation and equity growth. Historically, participation beats prediction.
And just like March Madness, sometimes the smartest play is simply staying in the tournament. Back to you, Manly.
All right, March Madness reminds us of something every single year. You can study the matchups, you can run the numbers, you can think you understand the path, and then when the game starts, reality takes over. Housing works in the exact same way. The market doesn't reward perfect predictions, it rewards preparation, participation, and perspective.
Yeah, and rates, they will move. Prices will fluctuate, and headlines, they always create fear. But historically, the people who build real financial momentum aren't the ones who waited for certainty. They're the ones who stepped forward when the outcome was never guaranteed. Because long-term wealth isn't built in perfect conditions. It never has. It's built through consistent participation.
So, if there's one takeaway from this episode, it's this. The goal isn't to win the perfect bracket. The goal is to stay in the tournament long enough for the math to start working in your favor.
That's right. And here's something wild to think about. The longest verified perfect March Madness bracket ever recorded only lasted 49 games. There's a total of 63 games. So even the best predictions fall apart well before the championships.
Here's another interesting factoid that I'm going to tell you. Did you know why I'm wearing this crazy bear hat today and why I have this amazing bear shirt on? It's not because of those stinky Chicago Bears. It's because it's National Bear Day, like the animal. Grizzly bears, black bears, brown bears, polar bears, all those guys. I love them to death. Hey, I appreciate that we're giving you these lessons today. Hey, just a reminder, perfection isn't the strategy. Participation is. We'll see y'all next week.
Girl from the heart of Wisconsin to the waves of Hawaii. Manly and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little home. the Mortgage 101 podcast where real talk meets home at last. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast.